Joel, good morning. Let's start off with Oracle here. I'm kind of drawing a parallel to PeopleSoft almost 20 years ago. That was really focused on HR. This is a more industry-specific bid, but it also has implications outside of healthcare because there's DoD contracts involved with Cerner, and the sort of technology you need in health tech these days is translatable to other areas, as we heard from Microsoft in its bid for Nuance earlier this year, right?
Yeah. Yeah, exactly. I mean, I think, Oracle, obviously, investors aren't loving this deal in the near term. It's been one of those things. Oracle's, they've tapped the debt market to really kind of, fund their buyback, range that they've been on for the past several years. So the all cash deal is a little bit, kind of taken negatively, and obviously it's probably going to impact their credit rating. But as you just touched on, I mean, Microsoft really kicked things off, with the Nuance deal. And as Julia just kind of described, really eloquently as well, there's a lot of inefficiencies in the healthcare industry, and it's not digitized yet. We need to head to that direction. And I think Oracle, is trying to go, move to where the puck is going. And to me, healthcare is a huge opportunity with a massive TAM moving forward. So the deal, I think, longer term it's gonna play out, gonna make a lot of sense from a strategic point of view. And then obviously it follows, their quarter they put up just a few weeks ago, which to me was really strengthening their case to be the next Microsoft. I know it's still very early, but the rev is starting to grow at a healthy clip. Margins were very strong as well. So Oracle's finally, it feels like they're turned the corner amongst all those dinosaur kind of tech names, and they're kind of heading in the right direction to maybe where Microsoft was just 7 years ago.
So tell me, what's your philosophy on what to buy in this environment? It seems to me a big question is, what happens to demand from here? We've been spending most of 2021 talking about supply issues, but now especially that we're not going to get this build back better thing for better or for worse. We're starting to get recalculations of what that means for demand, which I guess has questions for revenue and growth, right?
Yeah, I mean, I know, it's kind of someone mentioned it on the previous hour about this being a stock picker's market, and it's really never been truer. I mean, and to me, I think the biggest issue for tech is the shift from the Fed and global central banks. That's the big difference this time. COVID is viewed as an inflation tailwind versus a growth headwind, and that's where high growth, high multiple tech stocks are going to struggle, and the Cathie Woods of the world and the profitless tech names, I think the bid's going to be it's going to be spotty, to say the least. So I think when I'm talking to my clients, keep a little bit more defensive. So that's whether it's Microsoft and Google large cap spectrum. Look at IT services. Look what Accenture put up last week. Extreme, robust trends across the board. Visibility continues to kind of increase. And to me, we're still in the early part of a multi-year cycle towards digital transformation initiatives. So names like Accenture, Infosys, Globant, they really benefit from this digital transformation trend, and they're not crazy expensive. And then, moving down a little bit to the semiconductors again, look at Marvell. Here's a company exposed to multiple secular trends, whether it's enterprise storage, 5G, cloud infrastructure. And then kind of just semi-equipment, they are the arms dealers for almost every secular trend we can kind of list off, whether it's EV, AI, 5G. And I think you just want to keep it simple, not overthink it. But I'm very cautious on the high-flying multiple stocks that really outperformed in 2020. They've been struggling this year, and I expect the struggle to continue.